David checked his portfolio on a Tuesday in March, watched a number that had taken him 6 years to build lose nearly a third of its value in the span of about 4 weeks, and closed the app without doing anything else that day. He didn't sell. He also didn't add anything new that particular week, frozen somewhere between two instincts pulling in opposite directions. What happened over the following 18 months to people who stayed the course versus people who acted on that fear is where this story actually gets interesting, and the specific numbers involved are worth walking through carefully. My name is Emory, and if you've ever wondered what actually happens to money during a genuine market crash, not the theoretical version, but the real mechanics of what separates investors who recover from ones who lock in permanent losses, then this video should help clarify exactly that, using one of the sharpest, fastest crashes in modern market history as the case study. And if that's useful to you, sticking around and subscribing helps this channel keep grounding. Most people think a market crash is primarily a story about how far prices fall. They are missing the more important half of the story, because the 2020 crash isn't remarkable mainly for its depth. It's remarkable for demonstrating, with unusually clear data, exactly what separates a temporary paper loss from a permanent, realized one. And that distinction is the entire lesson this specific event teaches better than almost any other market period in recent memory. Here's what actually happened in sequence. Starting in mid-February 2020, broad U.S. stock indexes began declining as pandemic-related economic shutdowns spread globally. And by March 23rd, roughly 5 weeks later, major indexes had fallen approximately 34% from their February peak, one of the fastest declines of that magnitude in market history. This wasn't a slow, grinding decline that gave investors time to adjust gradually. It was compressed into a period so short that many people's first real reaction was simply shock, followed immediately by a decision they had almost no time to think through carefully. Someone might reasonably ask why the speed of a decline matters as much as its size, since a 34% loss is a 34% loss regardless of how quickly it happens. It's a fair question, and the honest answer involves psychology as much as math. A gradual decline over many months allows time for emotional adjustment and often for more considered decision-making, while a rapid, compressed decline tends to trigger a much stronger fear response, precisely because the brain hasn't had time to process the change before being forced to react to it. This is part of why the 2020 crash produced such a clear behavioral split between investors. The speed itself amplified the emotional pressure to act. Here's where this gets genuinely interesting, because the recovery that followed was just as unusual as the decline. By August 2020, roughly 5 months after the March low, major indexes had fully recovered to their pre-crash February highs, one of the fastest recoveries from a bear market decline in market history. This means someone who held their entire portfolio through the decline without selling experienced a genuine, if uncomfortable, paper loss that fully reversed within about half a year, while someone who sold near the bottom, a common reaction during the sharpest part of the decline, converted that same paper loss into a permanent, realized one, and then had to make an entirely separate, much harder decision about when to re-enter a market that was already recovering. This connects to a mechanism worth naming precisely. A loss only becomes permanent at the moment of selling. Before that point, a decline in portfolio value is, mathematically, an unrealized paper loss, real in the sense that it reflects current market value, but not locked in as an actual financial outcome. Someone holding through the entire 2020 decline and recovery experienced a 5-month period of genuine, significant paper losses, and then, without taking any action at all, ended the period roughly back where they started, plus whatever dividends or contributions occurred along the way. The mechanism that produced this outcome wasn't skill, prediction, or timing. It was simply the absence of a specific action during the decline. Someone might reasonably ask whether this means selling during a crash is always the wrong decision, since there are genuine scenarios, an emergency need for cash, a fundamentally changed financial situation, where selling might be necessary regardless of market conditions. It's a fair distinction worth making honestly. Selling out of genuine financial necessity is a different decision than selling purely in reaction to fear about further declines, and the 2020 data specifically illustrates the cost of the second type of decision, not the first. Someone forced to sell for a real, unavoidable financial need faces a different calculation entirely, and that's a legitimate, sometimes unavoidable outcome that this particular lesson doesn't apply to in the same way. There's a second mechanism worth examining directly from this same period. What happened to investors who continued making regular contributions throughout the decline, rather than pausing or stopping entirely? Someone contributing a fixed amount monthly throughout February, March, and April of 2020 was, by definition, purchasing shares at meaningfully lower prices during exactly the weeks when the market bottomed. A direct example of dollar cost averaging benefiting from a downturn rather than simply surviving it. This doesn't mean the contributions made during the worst weeks felt good in the moment. They almost certainly didn't. But the shares purchased during that specific window went on to produce some of the strongest returns of the entire recovery period, precisely because they were purchased near the low point. Someone might reasonably ask how someone is supposed to know in real time whether a decline is a temporary crash likely to recover or the beginning of a longer, more permanent decline. Since the 2020 recovery looks obvious in hindsight but wasn't obvious at all in March of that year. It's a genuinely fair concern, and the honest answer is that nobody, including professional investors managing significant portfolios, reliably knew in real time which outcome was coming. The specific lesson from 2020 isn't that crashes always recover quickly. Some historical downturns have taken years rather than months. It's that the decision to hold through uncertainty without requiring certainty about the outcome in advance is what allowed investors to benefit from this particular recovery, precisely because they didn't need to predict the bottom correctly. They simply needed to not sell near it. This is worth connecting directly to the broader mechanism of long-term investing, rather than treating 2020 as an isolated, unusually fortunate event. Historically, the U.S. stock market has experienced numerous declines of 20% or more, and in the vast majority of documented cases, indexes have eventually recovered to new highs, though the specific timeline for recovery has varied considerably, from months in cases like 2020 to multiple years in other historical downturns. The 2020 crash is a particularly clean, compressed example of this pattern, but it's an example of a broader historical tendency, not an exception to it. By the time this specific period is viewed with several years of additional distance, the data tells a consistent story. Investors who maintained their existing positions and continued regular contributions through the 2020 decline experienced a temporary, several-month period of significant paper losses, followed by a full recovery and continued growth well beyond pre-crash levels. Investors who sold during the sharpest part of the decline converted a temporary loss into a permanent one, and many who did so faced the additional, genuinely difficult challenge of deciding when to re-enter a market that had already substantially recovered by the time renewed confidence returned. The math doesn't reward panic, and it doesn't punish someone for feeling afraid during a decline either. It simply rewards whether that fear gets acted on or not.